just we'll call it to order here, and then Dean will take over, okay? If that sounds okay to you. Good to see you, Dean.
Yeah, sounds great. Good afternoon, everybody. Welcome to another installment of the workshop Colloquium. Today we have Jackson Dorsey, who's one of our own. He's an assistant professor in the Kelley School in the Business Economics and Policy Group. He's also going to be a young scholar in the Young Scholar Symposium in May. And so he's been to the workshop before he knows the rules, so he's going to go for 20 minutes or so. It's a fairly technical paper, as you probably noticed, so he might go a bit longer, and then I'll take the cue, and you can just raise your hand or send a chat, however you like, and I'll try to manage that as best I can. So anyway, Jackson, go ahead and take it away for a bit.
Great, thanks, Dean. You guys can see my slides, right?
Yep. Yes.
Yep. Great. So thanks for having me. I've been hoping to join for a little while now, but kept getting delayed, and we figured we'd go ahead on Zoom at this point. But should mention before I get going that this is a joint project with Gautam Gaurashankaran, who's at Arizona, and my colleague Andrew Butters, who's here at the Kelley School. So what got us thinking about this project was that we've seen a massive growth in renewable energy generation over the last decade, but almost all the renewables that we've been adding to the grid are coming from intermittent sources like wind and solar power. And what that means is that solar farms, for example, are going to stop producing when a cloud comes overhead or when the sun sets in the evening. So in the absence of electricity storage technology, fossil fuel generators are still going to be crucial for reliably running the electric grid. And one thing that we should remember is that when we run an electric grid, all electricity consumption has to be generated at the exact same time we're using it. So every time we turn on our air conditioner, some power plant has to ramp up and meet that demand at the exact same time we're using it. So this intermittent nature of wind and solar power could potentially add additional costs to running the reliable electric grid. And I'll talk a little bit more about that as we go along. But battery storage could offer a potentially important complement to renewable energy. And batteries could do so in the following way. Batteries could act essentially as arbitrageurs on the electric grid. So think of it as batteries could charge up when renewable energy sources are abundant and then discharge when renewable resources are scarce. And in that way, storage could potentially lower the social costs of adding more renewables to the grid. So to illustrate some of those points, I'm going to show you some figures from California, which is the focus of our study. So in the left panel here, I'm going to show you how demand for electricity tends to evolve across the day. And the key thing I want you to take away from this picture on the left is that people are using the most electricity in the evening. So think around 6, 7 p.m. when people get home from work, they turn on their TVs, they turn on their air conditioners. So that's the highest demand time of the day. On the right, we can see how solar is producing across the day and how that's changed over time. California has added a ton of solar generation over the last 5 years. So we see a lot more solar generation. But one thing I want you to notice in the picture on the right is that all this solar generation is coming during the middle time of the day, so kind of around noon or 1 p.m. If we take the picture on the left and subtract the picture on the right, we get what's called net load. So you can think of this as the amount of demand that has to be met by dispatchable power plants. So things like natural gas plants. Whatever people are using that isn't being met by solar has to be met by typically natural gas power plants. And so we get the following picture if we take that left picture and subtract the right picture. This is what's called net load. And so if we look at in 2015, net load was pretty flat through most of the day, increased a little bit in the evening hours when people were coming home from work. But if we look at more recent data, net load is really declining a lot in the middle of the day and then increasing again in the evening. So what's happening here is when those solar plants come online, gas plants turn off, and then in the evening, those gas plants have to turn on really quickly, actually, as the sun starts going down. So what's wrong with this double humped pattern that we're starting to see in 2019? Well, the first is that solar generation is not occurring when demand and therefore marginal cost is the highest. During those evening hours, that's when the most expensive power plants are going to be running. So if we could pick any time of day to get solar, we'd ideally like it to be at 6 p.m. It's not happening at that time. And the other thing is that this variation in net load across the day can also raise what's called ramping costs. So these gas power plants were not really designed to turn off and on all the time. So the fact that you're having to turn them off and then ramp them up quickly in the evening can add additional cost to running those power plants. And we can see this if we look at wholesale market price data from California. So again, so here I'm just showing you how market prices have changed throughout the day in California in the wholesale electricity market. And prices are pretty similar during the middle of the day, but we actually in 2019 are seeing much higher prices in the evening. And the reason for that is because of these ramp up costs. It's been really strenuous for natural gas plants to meet that demand in the evening. So we're seeing prices spike in those evening hours when we have to convert quickly from a lot of solar to all gas generation. So where do batteries come in? Batteries could potentially lower the cost of adding this solar generation to the grid by storing electricity during the middle of the day and then releasing it during those evening hours. I do want to highlight that there's a limit to the value of large-scale storage. And the reason is that these batteries are going to be acting as arbitragers. So essentially, they're going to be buying low. They're going to be buying electricity when it's cheap during the middle of the day, and then selling it in the evening when prices are high. But as more and more batteries enter the market, once you already have a lot of batteries discharging in the evening, prices are going to start to drop in the evening, and the value of additional battery investment is going to start to decline. Another thing I want to highlight is the cost of the battery technology itself has been declining really rapidly over time, but batteries are still relatively expensive. And that's a big reason why we don't see that many batteries yet deployed on the grid. We have seen a lot of movement in the policy space that is encouraging more battery investment. So California, for example, has mandated that a certain amount of batteries need to be deployed on the grid by 2024. And we've seen several other states subsequently enact battery mandates as well. So we've seen policymakers a bit worried about grid reliability and therefore are adding mandates for storage. So the main goals of our paper is we want to evaluate the adoption trajectory and the welfare effects of adding this new battery technology to the grid. So along those lines, we'd like to understand how does renewable energy deployment, how much renewables are on the grid, and how do falling capital costs of battery technology affect the optimal time that we should see investment in electricity storage technologies. And we also want to understand the welfare and distributional impacts of this new technology entering the market. So as you add more batteries to the market, how does that affect welfare and prices? And what are the distributional impacts on other participants in the market? So how do batteries affect generator revenues for individuals that own fossil fuel resources? How does it affect utilities that have to actually serve load? So think utilities are buying power and then delivering it to consumers. How is it going to affect them? So that's the first thing we want to answer. And then the second thing is we want to understand the role of policy on battery adoption. So to that end, we want to understand how do battery mandates shift adoption compared to a case where we don't have any mandates or subsidies for batteries, and how expensive is that? What are the social costs of having a mandate policy like that? And then relatedly, we see a lot of states that have renewable energy standards. So we want to understand how much storage investment is optimal to meet a certain level of renewable energy goals. So those are kind of the main questions that we're going to try to answer here. And to do that, we're going to develop some new theoretical and empirical frameworks, and we're going to add a few contributions to the literature. The first is we're going to develop a dynamic equilibrium model of battery operations. So what that model is going to look like is there's going to be a bunch of batteries participating in the market, and they're going to smooth prices out as more of them enter the market by charging and discharging throughout the day. We're going to solve that model for a bunch of different levels of batteries that could potentially be present in the market. We're also going to develop some new time series techniques to model how electricity demand and supply evolve over time. That's going to be really critical for us, because if we want to predict how prices will change as batteries enter the market, we need to know what the supply curve looks like at different times of the day to understand if batteries discharge, how much will that change prices. And then finally, we're going to link our model of how batteries are operating on the grid to a model of battery adoption to think about when we would expect to see investment in batteries in different types of policy settings. So kind of the big picture on our model, our model is going to have these two main components. The first is what we call the operations model. So in the operations model, we're going to solve for the charge and discharge decisions of a battery at a very high frequency. So batteries in the operations model are going to make a decision every 5 minutes of whether they want to charge up, they want to buy electricity, or discharge, sell electricity to the grid. And we're going to incorporate several features that we think are important given the electricity market institutions that we think are key to getting the value and dispatch of these storage correct. And so this operations model is going to therefore feed into our model of battery adoption. Once we understand how batteries would be dispatched, we can calculate how valuable a certain level of battery investment would be. We can feed that into a model of investment of when and how much batteries would we see in the market over time. So this is going to be a competitive model. So the way to think of the model is there's going to be a bunch of very small players that can invest in this technology and then operate the technology in the market. So that's kind of the big picture on the model. Let me tell you a little more about the data that we use. Our main data set comes from California. We mainly chose California as the focus of the study, just because they've seen so much additions of these renewable sources. So that's going to be really useful for us to understand how the value of storage is changing as more renewables come online. So the data from California is going to give us electricity load, which is just another word for electricity demand, and how much each type of generation resource is producing every 5 minutes. And we can also see wholesale market prices every 5 minutes as well. So that data on demand for electricity, supply for electricity, and prices is going to feed into our operations model, thinking about how batteries would be optimally dispatched throughout the day. We're also going to combine that with data from the Department of Energy to give us specifications on current frontier battery technologies that are currently being added to the grid. And we're also going to take information on the policies in California from California Senate legislation. The key one here is California has currently about 30% renewables, but they're going to have 60% by 2030, according to state law. So that Senate legislation is going to allow us to know how much renewables will be online in the future, and we're going to take that as given when we're solving our model. The last thing that we need is this data on battery capital costs. We're going to take that from the National Renewable Energy Laboratory. In order to think about when investment would occur for these storage technologies, we need to know how expensive are batteries right now, and how much cost decline do we expect to see in the future. So this is what the Nrel data looks like. Each of these gray lines shows a single cost projection from the literature. And so the blue line shows the average cost projection over time. And what you can see from the picture is that most projections suggest that the cost of this technology is going to decline substantially over the next 10 to 20 years. We're going to take these projection data to estimate a model of how costs are going to evolve in the future, which is going to feed into the model of when we would see investment in the storage technology. So let me just give you a little more detail. I won't go too in the weeds on the model here, but just to give you a little more detail on each of these two components of our model. So in the capacity adoption, like I said, we're going to have a competitive model. So the way to think of it is there's a lot of very small identical potential battery operators that we can all call agents for short. And each agent can install a single unit of battery capacity at a single point in time. If an agent decides to adopt the technology at year Y, they have to pay whatever the current capital cost is. They know what current capital costs are. They don't know exactly what capital costs are going to be in the future, but they have rational expectations about how they're going to evolve. And we're just estimating that future capital cost evolution from that picture that I just showed you. So agents also are going to know how renewable energy capacity is going to evolve over time. That's been set exogenously through this California policy that's just scheduling how much renewables are going to be coming onto the grid over time. So batteries are going to, each of these investors is going to make a one-time decision about when to invest in this technology. After they make the investment, they don't make any further decision, but their battery is going to depreciate over time with use. So the capacity adoption problem, don't want you to get too in the weeds on the math, but I just want you to kind of look at these two brackets. Basically, the trade-off that is being made here by the investor is they're thinking about the value of adopting today. If they adopt today, then they can get a flow profit from operating in the electricity market. That's this pi function. If you adopt a battery today, you can start buying and selling electricity in the market, and you can get profits from that. And then you also get future profits from operating your battery in future years in the market. If you decide instead to wait till next year, you likely are going to get a lower cost. The technology is going to be cheaper next year, but you're going to forego that profit that you could have made in the market this year. And so the key here is that how do we get this pi function? How valuable would a battery investment be this year? That's what we're going to get from our operations model. So by solving how the battery would operate on the grid, we can get an estimate for how valuable that flow profit is going to be of investing today, which will allow us to solve the investment problem. So let me tell you a little bit about the operations model. So we're going to solve the operation model separately for a bunch of different values of aggregate battery capacity. So think of this as, in one case, we'll solve a model where there's only a few batteries on the grid, and then we'll solve the model separately as more and more batteries enter the market. And then we'll also solve the battery across time. We'll solve the model across time. The reason why we want to solve the model across time is because, as you saw in those first figures, a lot more solar generation is coming on over time. So by solving the model over time, we get a nice approximation of how the value of a battery investment is changing as more solar generation has come into the market. So we're going to solve our model for a bunch of different battery capacities, a bunch of different levels of solar generation, and then we're going to run a regression to approximate the per unit value of storage investment, which is going to feed into that investment model. So what are batteries going to be doing in the operation model? They're just going to maximize expected revenues from their storage operations, which is what they're going to do is make these charge and discharge decisions every 5 minutes. So just to give you a flavor of what their charge discharge decisions depend on, they just depend on what time is it during the day, which I showed you in the pictures is going to be important. If it's 12 p.m., their strategy is going to be different than if it's 3 in the morning. How full is the battery right now? So if it's 50% full, they may want to do something different than if they only have 10% left. What is current demand for electricity in the market right now? What are current prices? And how many generators are online currently? That's going to allow us to embed kind of those costs of ramping that I discussed at the beginning. So that's kind of the key here. That's all I'll say about the operations model, just to save a little time for the results. Happy to answer some more questions about that later on. The operations model is pretty difficult to solve, and we developed some new computational methods to deal with that. But let me show you some of the results from our model. So first, I'll show you the times of the day when the batteries are charging and discharging. So as we might expect from those pictures, so each of these lines shows the results of how much battery discharge we would see for different levels of batteries. So the pink line is a really big battery fleet, so a ton of batteries in the market. And the gray line is a fairly small battery fleet. Batteries are going to discharge in the morning when people kind of get up before they go to work, and then they're going to charge up during the middle of the day when solar is coming online, and then they're going to discharge in those evening hours when people are coming home from work. So what are the price effects of those batteries entering the market? The black line shows what prices look like throughout the day without any batteries. And then these lines down here show you how prices change as more batteries come online. Now, this large storage fleet we can see is having pretty large price effects on the market. So on average, throughout the whole day, if we had 15,000 megawatt hours of storage, the price of electricity would fall by about 15%, and it would fall by over 30% during those peak hours, which is really when we're seeing the most strain on the grid, because of that quick ramp up that needs to happen for the fossil fuel generators. Just to show you a little bit, once we understand how prices are changing, we can analyze how profitability is going to change for different participants in the market. The key thing that I want you to take away here is from the second column and the third column. So fossil batteries are going to be smoothing out prices across the day, and what that's going to lead to is a large transfer of rents from fossil fuel power plants to utilities. So if you own a gas plant, your profits are going to go down a lot. If you're a utility like Southern California Electric or Pacific Gas and Electric that has to serve load, the prices are going to go down quite a lot for you. So that's something important to keep in mind when we think about, in the long run, this type of battery investment is going to change how many fossil fuel generators we'll see in the future, and retirements, et cetera. That's not in our model, but these have some important takeaways for that. The other thing I want to show you is, by solving the model as more and more solar comes online, what we see is that there's a strong positive association between battery value and solar generation. As we see more and more solar generation online, the value of battery dispatch has been increasing pretty substantially, and we'd expect it to increase further as more and more renewables come online. So let me show you some, all of these are going to feed into the investment model. Let me show you some of the results from our investment model. The first thing is we can use our investment model to show what adoption of batteries would look like if we didn't have any mandate or subsidy for that technology.
Jackson, let me interrupt just very briefly. Can you wind this down within 5 minutes, you think?
Oh yeah, no
Yeah,
problem.
fantastic. Thank you.
Yep. Sorry, it took a little longer than I
That's
thought, but I'm getting close. So I'll just show you kind of the last results here. So the first thing I want to show you, so this is what battery investment would look like if there was no mandate or subsidy for batteries. And without mandate or subsidy, we find that battery adoption wouldn't really take off till the early 2030s. So we're still would be about 10 years away from seeing any investment if there wasn't any if there wasn't any policy and intervention. A lot of the reason for that is that battery investors are going to want to wait for the cost of the technology to decline. So this yellow line is showing what battery investment would look like if we allow potential battery investors to be myopic about future cost declines. If they just think that the cost of the technology today is going to stay that way in the future, then we would start to see battery investment in the late 2020s. But with forward-looking behavior, you don't see it until the 2030s because investors know that if they wait a little bit longer, they can get a much lower cost of the technology in the future. The other thing I want to show you is that as the renewable mandate is really crucial for getting battery investment. So California has a 60% renewable mandate by 2030. If California were to switch to a renewable mandate that was only, say, 30 or 40%, then we'd hardly see any investment in battery adoption. So you really need a few things to happen to get battery investment. You need to have substantially lower costs than we have right now, and you need to have quite a lot of renewables on the grid. Otherwise, you wouldn't see investment without a mandate. So the last thing that I'll show you before I wrap up is we want to use the model to analyze the welfare effects of particular energy policies. So let me talk about the second one in particular. So this is kind of an important policy question because a lot of states have been considering these battery mandates. So what we want to understand is what is the social cost of a battery mandate relative to the competitive equilibrium investment path. So what we find is that the California mandate increases social costs by about $154 million. Put in terms of the number of California residents, the battery mandate costs about $4 per California resident. And the reason why there's a cost to the mandate is because the mandate moves adoption forward by about 8 years compared to what would have happened without the mandate. The cost is relatively low, and I think that the key intuition for that is that when you already have a strict renewable standard, we're going to likely see investment in this technology anyway. It's just slightly speeding it up compared to what would happen without the mandate. And so that for that reason, the cost of the mandate to ratepayers, for example, is not particularly high, given this renewable standard that's already been put in the market. So let me just sum up here. So we develop the first equilibrium model of storage adoption and pair this with a model of battery operations and include a lot of features of the market that we think are important to getting the value of batteries right. One result that I went through I didn't talk about, batteries are going to be really important for reducing the cost of electricity generation in California, particularly given their ambitious renewable goals. Even though we won't see a lot of those cost reductions for several years to come, we do find that battery investment is going to be valuable in reducing the cost of adding that generation to the grid. We do find that battery entry substantially reduces these peak prices, which also reduces revenues for fossil fuel generators, which has important implications about what type of investments we would see going forward. We see substantial complementarities between how much solar and the value of storage. And we find that the battery mandate speeds up adoptions by about 8 years compared to what would have happened without a mandate, and imposes a cost of about $4 per California resident. And again, I said the intuition for that is that when you already have a very strict renewable standard, we find that you would see investment in this technology even without the mandate. The mandate is essentially just moving that investment forward a bit compared to what would have happened without the mandate. So sorry for going a little long, but I'll leave it at that and be interested to hear your questions and comments.
Okay, thanks, Jackson. So we have one question already on the chat. Why don't Ann Lee, if you just want to ask yourself, or I can ask it for you, but feel free to go ahead.
Please go ahead and ask it.
Okay, so the question is, could you speak a little bit on pricing? Since you're using California data, is it more like a duopoly with SoCal and PG&E? And then what kind of externalities do you expect, and have you applied to wind power? Thanks, Ann.
So the way to think about like Southern California, Edison, and PG&E, so they're going to be buyers in the wholesale electricity market. So those utilities, they have a bunch of consumers that they cover in the different areas of California, and they have to buy enough electricity from this market to serve all of those households and businesses that are in their service area. They don't really have much power in the market in the following sense, that their consumers don't see the prices in the market, so they have to buy whatever their consumers are using. So the utilities are not really strategic participants in the market. They basically just buy at every point in time enough to serve their constituents. And then on the other end, you have a bunch of power plants that are bidding into the market, and CAISO is dispatching the power plants that can meet demand at the lowest cost. That's where batteries are a little bit interesting in this case, because in some hours, a battery is a buyer in the market. They're going to be charging up and they're going to be buying from the market. And then in those evening hours, they're going to be a seller. They're essentially competing against other power plants that are bidding into the market. The second question was about wind energy. So we do have wind in our model. There's just not quite as much action there. California has some wind, but just not nearly as much as solar, and wind hasn't been going up as much over time. You could definitely use our model to apply it to a market like Texas or the Midwest that has a lot more wind. And if the difference between wind and solar is that wind tends to generate the most in the middle of the night. So solar and wind are both not perfect in the sense that wind is generating when people are sleeping. It's generating the most when people are sleeping. Solar is generating in the middle of the day. That's actually slightly better. People use more electricity in the middle of the day than the middle of the night, but neither of them are generating the most kind of in that 6 p.m. hour. So you could still have a lot of value from adding batteries in a grid that has a lot of wind. In that case, the battery would be charging a lot more in the middle of the night and then discharging when people in the early morning and early evening, but it would probably be charging up more in the middle of the night.
Okay, I'm checking the queue here. I have a question. I mean, I have a lot of them, but let's just, I kind of want to focus on some of these mandates here. One is, did you consider what this market would look like if there were no renewable mandate? It seemed like you just took that as exogenous. Someone is actively encouraging the adoption of these mandates and the increase in these mandates. So that's sort of part one. And the second one is on the battery mandate. Isn't there incentive for, I mean, given that you have a solar or renewable mandate, isn't there incentive for these firms to invest in batteries? I don't, maybe it's in your model, but what is the, seems like this would be, you know, a vertical integration sort of opportunity for firms producing these renewables to be in the battery business themselves. I don't know how much of that is going on. So those are kind of two related questions.
Mm-hmm. So for the renewable mandate, that's a great question. Ideally, the model could incorporate that. We haven't done that, mainly just because the model is pretty difficult to solve as is. And if you wanted to incorporate the renewable investment being endogenous, then you would have to think about, we'd have to model not only the battery investment decision, we'd have to also develop a dynamic model for the renewable investment, which are going to depend on each other. So it makes the computation quite a bit harder. So we've kind of, the reason we started out modeling that way is because these renewable mandates, there's other literature that's talked about them, but they are seeming to becoming very prominent. They're maybe not an economist's best choice of the way to reduce emissions, but they have become very popular in different states in terms of meeting these climate goals. And so we've kind of taken that as fixed and said, given that these are very prominent policies, how do batteries kind of intertwine with that? With the caveat that, you know, the renewable mandate is not necessarily a first best policy. But it would be very difficult to endogenize that into the model. But one thing that is on our to-do list is to just add a little bit more discussion on that. So that's a good point. So the second thing was the incentives for renewables. So the renewable operator may want to invest, but one thing that's interesting about the renewables is their production is exogenous, so it's not really strategic. Once you invest in a solar farm, you're going to get production during the middle of the day, and you're not going to get production during the middle of the night, and you don't have any way to really control your production. However, as batteries enter the market, that can influence how profitable an investment in solar would be, which goes back to your first question. Mm-hmm. So one thing that we found surprising was that we thought that there would be, as more batteries enter the market, it's going to be a lot more valuable to invest in solar. And the reason why is if you have batteries that are charging up during the middle of the day, you'd expect that to push up prices in the middle of the day, which would increase profits for solar plants. And so we would think that more batteries would lead to higher profitability for the solar plants. But we actually found that the supply curve in the middle of the day is pretty flat. So even though batteries are charging up during the middle of the day, they actually don't change prices very much. So the profitability for the solar plants is actually not changing very much. So you could imagine that a solar plant would might want to invest in batteries to push up prices, but we actually find that battery investment doesn't increase the profits of the solar plants as much as we thought going into it.
Yeah. So just to follow up on this very quickly. So empirically, we find that the solar companies are not investing in batteries. These are separate companies that invest in batteries. And
no,
what's going on? How's this work?
So there's a mix of companies, and there's definitely a lot of the companies that are investing in batteries are independent power producers that own other assets in the market. So a a lot of these companies may own kind of a fleet of different technologies. Some of them focus on only renewables, but then there's also other companies that own a few gas plants and a few solar plants, and then also batteries. And you do see one common setup recently is that you're seeing like solar plants being built with batteries on site. So there definitely is companies that own both renewables and batteries. The ownership question is interesting, and one thing that we can do that I showed you some of the results is we can look at how profits change for these different companies. But one thing that we aren't modeling is like strategic interaction between natural gas output and batteries. Again, that makes the problem pretty difficult. But you could imagine that if you own a bunch of natural gas power plants, that's going to affect how you might dispatch a battery. So for example, say you're a gas power plant and you're making a bunch of profits in those 6 p.m. hours. Are you going to want to fully discharge the battery at 6 p.m.? Probably not, because that's going to reduce the profitability of your other assets. Now, in our model, all of the batteries are competitive. So that's mainly done for tractability, but that's why we're assuming that each of the batteries is so small that they know that on aggregate they can affect prices, but each individual battery is not exercising market power. Now, what we have done is we've solved the model for like one single company that like owns all of the batteries, because that's still a single agent problem. So we can solve it using our framework. And what we find there is if you had a monopoly that owned all of the batteries, they wouldn't want to discharge as much in the evening. They want to withhold capacity. And that's just because they're kind of doing what a standard monopolist would do, where they know that once they're discharging a bit, if they withhold, they can make they can make more profits on their first few units of discharge. So a monopolist battery owner would invest sooner because they'd have higher profits, but they would have less social value because they wouldn't discharge as much in the evening when the value of storage is the highest.
Okay, great. So Gustavo has a question. Would you mind stopping your share, Jackson?
Yeah. Sorry about that.
But go ahead. And then I'm keeping track of questions here, but Gustavo, go ahead.
Hi, really fascinating paper. I have a question that's probably more a clarification question. I was thinking about the prices that you are using. It's the final consumers are seeing a more flat price over the day, so the quantities are affected by that flat price. So in some senses, if you would allow for different prices at different hours of the day, the incentives for the investments on batteries will be even higher. So essentially, shouldn't these things be taken into account, especially for welfare considerations?
Oh yeah, so really good question. So one thing that's kind of unique and about these electricity markets is that, as you mentioned, consumers are basically just seeing a flat price. So no matter what is happening in terms of what are the batteries doing, what are power plants doing, households just pay the same price of electricity. So the way that we model demand is it's basically just vertical from the perspective of the wholesale market. And that's a little bit goes to the first question that was asked, which is demand is in our model is just a vertical line. So each hour of the day, consumers turn on their AC, and however much they're using, that's demand, and it's not elastic. It doesn't respond to the price in the market. So the way that the equilibrium is set is just the intersection of this vertical demand curve with the supply curve for the generators for that time. And so one reason you can see very volatile prices in this market is because demand can't respond at all. The only way that the market is clearing is by power plants shifting around which power plants are producing. Demand is not responsive at all. So in terms of welfare in the market then, we're essentially just assuming that there's some very high value of lost load. That's fair. I think that that's a pretty common assumption in the literature, that like avoiding a blackout is very valuable to consumers, much above even the prices that you see in this market. So welfare is basically just what is the total cost of supplying load. So what are welfare changes coming from batteries? They're reducing the total cost of supplying electricity to households, and that's by just shifting around production, charging up during hours where marginal costs are lower, discharging during hours when marginal cost is higher. And there's kind of no demand consideration there, and that's just kind of a feature of the electricity market, that consumers are not able to respond to the prices, so you just don't have any curvature to the demand.
Yeah.
Just a
Thanks.
quick
Go ahead,
follow-up.
Sure.
I was thinking that what considering the possibility of the batteries versus putting different prices for different hours as substitute policies, no?
Oh, absolutely. So one way of thinking about this, and one thing that a lot of people have wanted for a long time, especially energy economists have advocated for a while, is you would have a lot more efficiency in the market if consumers could respond. It's very expensive sometimes to have the only way that you meet demand is to turn on an extremely expensive diesel generator that costs, a ridiculous amount, is the only way to meet demand. It'd be nice if some consumers could see that price signal and say, oh, I just won't do my laundry till later today. That's probably a much more efficient way to clear the market in a lot of cases, but doesn't happen right now because of the current pricing structure. If you imagine that you have a world with real-time pricing, which I think is becoming a lot more realistic now that, with kind of the automation technologies we have, I don't really think that people would be in their households just like, oh, prices are $100 now, I'm gonna like go turn down my thermostat or not run my dishwasher. But you could imagine all of that being automated, right? So you just have kind of a computer in your house that says, if prices are this high, don't run don't run the dishwasher for an hour. Or if prices get high, turn the thermostat down a little bit. That type of policy would have kind of a similar effect to batteries, in the sense that when you have those evening hours, prices are high, you send a signal to consumers that says prices are high right now, use a little bit less of your dishwasher and air conditioning. And that's going to be one way of adjusting to those extreme fluctuations that are happening because solar is being added to the market. So I think that that's a really good point, that I definitely think as batteries as a potential substitute. Or I mean, they could be used together, but they're going to have similar effects on the market, consumer price response, and kind of these wholesale batteries shifting production around.
Yeah, thanks. I think we've got Brian next, and then Scott. So I'll just let you guys go.
Okay, so two things. The first one would follow pretty directly on from what you were just talking about, whether there's some way to kind of extend or apply this model to actually looking at the kind of options you're talking about of smarter thermostats, smarter control of appliances, or the other one, if you start to have a lot of electric vehicles and some fairly modest cost to connect them to the grid and use them to the storage, does this give you a way to kind of compare, okay, what kind of portfolio investment would make sense? And then the other question is whether you've looked at what would happen in a kind of optimistic scenario on storage prices if it declines like renewables have. that rather than dropping from 400 to 200, dropping in half, it drops down to 20% or 10%. Does that do anything interesting in terms of what might happen? Thank you.
Yeah, thanks for the questions. So in terms of modeling real-time pricing being integrated, I would say that our
Actually, my question was not so much real-time pricing. I mean, that from an economic perspective, you can see it. This is more specific policy options that might be incrementally politically feasible, and okay, some costs to connect, electric vehicle storage or smart thermostats as a slightly different and more feasible model. Yeah.
Right. Yeah. So I think that our model does speak to that. So basically, what are the batteries doing in our model? In our model, batteries are owned by these independent power producers, and they buy and sell to the grid. But if you imagine moving to a world where you have smart thermostats and some type of pricing response from households, then a battery in a house, a battery in an electric car could act in a very similar way that a utility-owned battery could act. So in that case, if we all have electric cars, we go home, we plug it in. When we're at home, there's an automated system, and basically you could buy and sell power from the battery that's inside of your electric vehicle based off of what's happening in the market. If you have real-time pricing, then batteries that are behind the meter like that look very similar to the batteries that we're modeling in our paper, which are buying and selling in this wholesale electricity market. So I think one way of applying our model would be if you do move to a world where there's ability to link in your either home storage device or an electric vehicle that has a battery, and you can also send price signals to and from that household, then you could use our model to look at how investment at the household level would look like. So yeah, that's a really interesting and important point that we've been thinking about a bit. And then the second, sorry, can you mention the second thing again?
Oh yeah, basically, if you just a very optimistic scenario for storage costs,
right.
rather than 400 to 200, if it follows like renewables actually have a much more drastic decline, both in terms of technology and learning curves, and you probably know the arguments that would be behind it, but if those drop down to a tenth or something, does anything interesting happen in this model if you've looked at that?
Well, okay, so what we are doing is when we're modeling the cost evolution, we aren't like assuming that it will follow that mean path that I showed you.
Okay.
We're modeling uncertainty in the evolution. So there was kind of some projections that are a lot lower than that, some that are higher. Now, one interesting thing about that is we know what costs are now, but potential battery investors know that there's some chance of a big breakthrough happening. That makes them less likely to invest today, right? Because there's a lot of value of waiting till next year or 5 years from now if you think that there's a possibility that a big price drop will happen. And that is incorporated in our model to the extent that we have uncertainty across those different projections. And so that adds a lot of value to waiting. If they knew for sure that prices were going to go down, then they'd be even more likely to wait till that time. But then they would just kind of all start adopting right away once those prices drop to a really low level. So obviously, once the costs go down a lot, you start to see investment. But the interesting thing in the model is the uncertainty about how much cost could decline in the future makes investors weary of investing now.
Okay. Just make
We
relatively.
have just 5 minutes left, Brian, and I know we've got Scott and Angie. Do you want a quick follow-up or you want to?
Just a very quick one.
Sure.
Policy options like we're done for renewable offer people a guaranteed price to deal with the uncertainty. That's all. Thank you.
Thank you.
Okay. Yeah, so we got Scott and Angie. We're down to 4 or 5 minutes, so I'll let you guys work it all out between the three of you.
Thanks a lot, Dean. And Jackson, this has just been fantastic. And we haven't notified the group yet, so I'd forgotten earlier. Will you be able to stay on for a few minutes after this is over in case there's any follow-on questions that we run out of time for? No worries if you have another minute.
Yeah, no, I can stay probably till 1:15.
Okay, no, that's fine.
Yep.
So
Yep.
just as a heads up, everybody, if we don't get to you in the next few
Yep.
minutes, we can continue the discussion then. So like I said, no, this has been great. My question kind of relates to something that Brian brought up in his remarks there, and I put it in the chat box a little bit, and it's not very well thought out, but I think it's related. So Mike Mattioli over at Maurer and I have been doing some work on blockchain-enabled microgrids and looking to see how they're being rolled out, here in the U.S. and also in Switzerland and Australia in particular. And it just seems to me that has a lot of potential, especially at the community level, maybe if there's enough distribution and enough incentives placed to also, drive down battery storage costs. It's a very different and less centralized model than what you're kind of focusing on here, but I'm wondering if you've been following, that trend at all. It's still really early days. And if you see, maybe a potential, follow-up project to look at that, because I think it could be fruitful in comparing what you're doing here.
No, so actually, so thanks for the question. I know very, very little, if anything, about blockchain enabled microgrids.
I know, right?
So,
and that's
so
okay. It's a very nerdy circle. Who knows much about that stuff? But yeah, no, happy to chat more about that though. Maybe after we're done, and it could be cool.
Yeah, no, I'd like to hear more about it, and then maybe if you give me a little bit more background, I could speak or think a little bit, brainstorm a little bit more about how that would work in with our model.
Oh, no. For sure. Yeah, it's basically community-based power generation, right? So it's neighbors trading with one another via a blockchain, maybe involving a cryptocurrency. And it's an interesting, more distributed way that has benefits for climate change and resilience, and maybe even even cybersecurity, frankly. But we can talk more about that later. Angie, did you want to maybe go next in the time we have left here?
Sure. I just when the market's based on a lot of information and data being fed back, I just wondered, how you're building in a conflict, portion of this. What happens when the data stops? Or what happens when, the power grid actually does shut off, which means no data sharing is occurring or has to be transferred through another source. So it's more of if it was actually deployed, how would those type of occurrences like Texas, quite frankly, impact the market, and how do we conflict that, I guess, is the big one. I don't want to bill for $4,000.
Right. So I think so a couple things. So both Texas and California both have a wholesale electricity market. So they both have basically what's called an independent system operator. You've probably heard in Texas, so it's called ERCOT. In California, it's called CAISO. They're basically like a bunch of engineers that sit somewhere and they're collecting these bids from suppliers and from the utilities, and then clearing the market. So the data, I wouldn't say the data potentially stops. So for example, like Texas still had power in some areas, and like the ERCOT office still had power, but they just didn't have enough supply to meet the current demand. So then what happened was prices were just extremely high. When you're at a blackout, it goes all the way to the price cap. So in that case, and even in a blackouts that have happened in California or Texas, you still would have some power typically, especially for the grid operator would still have power. They have backup generators, et cetera. But what would happen would be like if a battery was online, and they had something in storage, then they could discharge during that situation to help mitigate the potential blackout. So what happened in Texas was there just was not enough fossil fuel power plants to meet the amount of demand. If you had a battery, if it wasn't frozen, which is very well possible because that's what happened to the gas generators. If it wasn't frozen, the battery could sell power and make quite a lot of profits during those periods. So I think that's how I would tend to think about that type of situation.
Okay, we're at the top of the hour, everybody. So we'll thank Jackson. He'll hang around for those who want to hang, but thanks everybody and see you next week.
Very interesting. Thank you.
It sure is.
Yeah,
thank you, Jackson. And just as a quick reminder, guys, there's no research series event this Wednesday, just so you don't jump on it Wednesday. But that was great, Jackson. Thanks again. And for those able to hang out, we can continue discussing for a few minutes.